Okay, folks, welcome back. This is our midweek review for December 18th, 2019. All right, so we have our dollar index as our daily chart, and we can see so far we had a pretty nice little bounce off of that 96.60 level. We traded back above the equal lows in here, and we traded back into this last up close candle, which is a bearish order block. The bearish order block, the mean threshold of that, it could still trade up into that around 97.52, 97.55. That could be still in the cards. I'd like to see it not do that. I'd like to see it show some respect of this upside candle and react as we would expect it to in the form of a bearish order block and get back below these equal lows. If we trade higher, the buy side liquidity is resting above this swing high here. Then we have the balanced price range in here. We have a single up close candle and a single down close candle that's passing through this area in here. Okay, so price goes above buy side liquidity and it trades through this balanced price range in here. We have another layer of buy side liquidity in the form of these relative equal highs. I don't see that as the likely draw on liquidity, at least not for the remainder of the year, at least at this moment right now. It would have to be something pretty significant to change that view. The market is trying to digest, in my opinion, the Trump impeachment. So I've been watching it all today on C-SPAN and watching the senators give their views and such. And depending upon what we get from all that, everyone is expecting, obviously, the Republicans to put it aside and just not support it. And I'm of the opinion it's not going to stop regardless. They're just going to keep looking for other things to keep Trump in a quagmire, politically. So it's causing a bit of a problem for visibility in terms of where the market should go. And we're still in this, again, large trading range. Haven't done a whole lot, and I want you to go back and listen to the recordings. If you go back through all the recordings, or if you look at your notes, you can see that we've pretty much outlined this whole entire market profile for the dollar index on its daily chart for the better part of this year. So we haven't seen a great deal of movement because it's been stuck in a large consolidation and holding pattern. I'd like to see it trade below the BISI in here and attack the sell side liquidity, completely close this in and run lower. That's what I'd like to see happen. That would allow foreign currencies to rally and allow commodities to rally for 2020. So I'd like to get into some commodity markets in the coming year and look for some mega trades in that. But it's hard to find those types of trades when you have dollar held in consolidation, which is another reason why a lot of the commodity markets, with the exception of coffee just recently, if you look at seasonal tendencies, if you have that that level of content in the mentorship, you can see that we had a really nice run on the coffee market. So apart from that one, it really hasn't been a great deal of movement in commodities. Oil still held in consolidation, bonds still held in consolidation, and it all has to do with this overall macro consolidation that's being, I guess, held in continuation. These long-term higher time frame consolidations, once they give way, they allow very consistent and prolonged trending models, and when that happens, trading becomes extremely easy, whereas now it's a turtle soup, run for liquidity and no trend. It becomes a lot of contrary trading, selling rallies, buying dips. Everything's turtle soup. If you look at the price patterns that have formed in this chart, we have old highs being taken, then rejected, seeking old lows, running through them, shallow, then going back above, old highs, equal highs, running old lows, running old lows over here as well, and then finding rebalance points with the BISI and SIBI fair value gaps respectively. So I'm looking at this return back into here as a potential reclaimed bearish order block. Okay, because if you can see, we trade up into it here on this run up and then rejected. Then we've bounced here and we went back above, which disrupts the support and resistance theory, guys. And they would otherwise look to see it trade up. Not that they would expect this to be a bounce, they wouldn't see that. The run back up into here, they would see that as resistance and then look for it to go lower. And we've had 3 days of that, Monday, Tuesday, and Wednesday of this week thus far, trading higher. And again, we're at an area where we want to give it an opportunity to present itself as a reclaimed order block. And if it trades above this bullish order block, then our focus goes to how we deal with this balanced price range in here. And if we get above that, then obviously we'll be running out these relative equal highs. And I don't think it's a run above those equal highs and then a rejection. I think if it goes above here, it's underlyingly bullish. And then everything I said I would like to see would basically dissolve, and a higher time frame primary bull market for dollar would resume. But it needs to get above these equal highs to do that for me personally. Let's drop down into an hourly chart. All right, so here's the dollar hourly chart, and you can see Friday the 13th, we started to have the retracement here. This run here, off of a fair value gap, bearish order block, runs completely down, beautiful projection down into our 96.60 level. We talked about that on Friday's review. We came back rebalanced to here. All the SIBI is completely rebalanced, and all this drop down into here begins to move higher in a very uniform, balanced, it's completely rebalanced as it trades up like this. When markets are moving like this particular way or this manner, every time it rallies, it comes back, immediate rebalances. There's no real imbalances in all this price action, so it's being driven by a repricing model. So what it's doing is it's sending it higher, 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 higher without any of these long imbalances where it just takes off and it creates a imbalance on the upside or downside. You're not seeing any of that in here. We had one here, it came back, rebalanced, and then started small ranges building on top of each other. So this is a very efficiently delivered price. We have buy side liquidity resting here on an hourly chart, and obviously right above this short-term high. And then everything would move back to what was outlined on the daily chart. Not too much to speak of in terms of a 15-minute time frame for a dollar. Much of what I just said has been explained. We have one fair value gap in here. Price come down, hit that, and then bounce back above for the other side of the market where we have a premium fair value gap, whereas this is a discount fair value gap. And for some of you, you're going to ask what makes it that. When price was up here, and this was the only imbalance on the downside, if price was up here, this is the discount. And when price was trading down here and rebalanced to this fair value gap, this fair value gap was a premium fair value gap, which it trades up to, rebalances, and there it is. So it's a lot of that type of price delivery, and if it doesn't give you the opportunity to trade with your model because of that, then you either have to be a scalper or sit on the sidelines. It's as simple as that. But there's a lot of things you can practice one-on-one and 5-minute chart, even in this environment, and you've learned that in the mentorship core content. So let's move over to the euro dollar. All right, so here's the euro dollar daily chart, and really, again, it's nice to see these buy side liquidity pools being targeted like that. Yesterday we had an attempt to trade higher, failed to do so. We did get above the rejection block, which is the highest up close here, right here, and that close was 111.72.9. And on this candle on Tuesday, we saw the high come in at 111.74 and 6 pipettes. So we had one more attempt to run above, hit the rejection block, and then traded lower as a result. We do have a small little imbalance right in here, which closes at the high at 110.97. and 8 pipettes. We'll just call it 98. So it does have a little bit more downside that could occur in here that would be logical. And then we have the fair value gap that resides here. Now again, that's assuming that the dollar index does in fact find traction and trades above for its buy side liquidity pool on its daily chart. The run above these equal highs, if it can get a strong decline in here, that would be, well, it would help in terms of determining which side they're going to make a run for, because it starts to really break down. We still have a large pool of liquidity in here, and it could still come down here and leave the low intact for the year, because I still believe this is the low of the year on 2019 euro dollar. Doesn't mean that we can't come all the way down here, wipe this out just like we did here, and then maybe resume going higher or stay in a range. So again, these are the only levels I'm concerned about. And I've left these levels on here because I want to see how they trade this week, because it's an imbalance that, again, IPTA will remember these points of reference and be mindful of this one too, because this is the first demarker that starts the fair value gap, which is this candle's high. So we have this candle's low, this candle's high. That's the original fair value gap, but I've used this here, which was adjustment, because we had this rally into the SIBI, which ate into the imbalance to this point here on this candle's high at 110.69. I'm sorry, 110.96 and 9 pipettes. Dropping into an hourly chart. All right, dropping into an hourly chart for euro dollar. You can see there's really no imbalance that's required to come back up in here. All this was is a run on buy side liquidity, rallied, came down, rebalanced here. So SIBI has been rebalanced, and then there's a movement going lower, targeting relative equal lows. And again, there's a small little imbalance from this candle's high, 111.01, and the low comes in at 111.03. So relative equal lows here and to here to here, and a small little imbalance. We could see euro dollar drop down again. Next level of sell side liquidity is resting below these relative equal lows in here and then in here. Nothing terribly exciting on a 15-minute time frame. We had a little bit of a rebalance here. So we had a buy side delivery of price here to get to a premium fair value gap after trading into a discount fair value gap with bullish order block. Here to here, that's a model. This whole movement right in here, retracing down, buying it up here, that could be a complete model, and then your trading's done. It means you're not shorting here and riding it lower. You're buying it here, you're covering here, and you're out. That would be a model. The imbalance that's seen here, the SIBI, sell side imbalance, buy side inefficiency. Price has a buy side liquidity pool resting right below what would be the premium fair value gap when price was trading here. It trades down, runs equal lows, shoots it up, takes out the buy side liquidity here for anyone trailing shorts, rebalances, then sells off. That could be your model as well. Everyone that's going through this mentorship is going to have their own unique model. They're going to look for the specific things that they're looking for in specific time frames, and you all can be profitable doing that and really have one perspective. You know, this trade here, selling short here and covering, or buying long here and then covering. Some of you are probably short from up here with the expectation that we're going to trade down lower, and like I just outlined on the daily chart, and that's your model. The newer folks that are in here are taking too much of a singular view or comment that I'm using to illustrate something and assuming too much on that one single point or conversation topic, and assuming that this is the only way that's going to happen. Price is very capable of allowing all of us to be doing a multitude of different things and still use the content that I'm teaching. It sounds like it's not possible, especially if you're a new trader or a new student of mine. It just seems like we all should be doing the same thing. Now, that would be true if I said we're only going to use one market, one pair, one bias, We all have to work on one side of the marketplace only, and we're looking for one particular setup. And if you noticed, I don't do that. And the reason why I don't do that is not to hide my inability to trade or to hide the effects of using one model and then having it go into a period of drawdown and then, oh, I look like a terrible trader or a mentor. It's to keep the focus on your flexibility, because I don't want to, and I don't believe this is possible, force you into any one particular approach to using my concepts. You need to adopt one that you draw an affinity for quickly. Not say that you have to rush that, but the one that you go to first, I should say, not quickly. The one that you gravitate towards most. Some of you that are, just discovering me and just only know the optimal trade entry, which is just a simple 3/4 pullback on a fib, which I didn't invent. I understand the market conditions that makes that particular pattern work, and it becomes optimal without having to teach any of the higher order concepts that you'd learn in the mentorship. And it gives you an opportunity to see something visually repeat over and over and over again. Most of you have obviously matured beyond that and went to order block and breaker and now imbalance, BISI, SIBI, fair value gap. And now we've learned recently the immediate rebalance and how that's different from a deferred imbalance and rebalance of a fair value gap. When we look at things like this, it provides a complete immersion where you are allowed, and not by me controlling your visibility, I'm giving you the tools to go in and discover exactly what you're going to be good at initially. And then over time, you graduate into other approaches and it starts to complement your unique model. It doesn't detract from it. It won't discourage you because it's drawing your attention somewhere else. Understanding other models when you're in charter and you go into the trading plans that we're going to be outlining in 2020 for each individual model, it will help provide a complete view of the marketplace. So that way, when you look at price, you're not limited to saying, okay, well, I'm only good at this time frame and this type of setup. You can draw out to a higher time frame and be able to pull setups, and then or draw a bias from that and then work with a lower time frame in that direction where you have everything in your favor. Higher time frame, maybe you have seasonal tendencies, intermarket relationships all lining up, and then trading with short-term intraday volatility, daily range expansions, time of day theory in concert with that. Then you have every avenue of high probability on your side. That's the discipline that is required and knowing what you're looking for. But there's other ways of trading where you don't really have to have a bias and you just trade intraday volatility on a scalping basis. And you get your 10 to 15 pips a day doing that, which requires a lot of transactions, and your strike rate in the beginning won't be very high because you're going to feel impulses to hold trades longer, especially if you start to move fast. You start thinking your 10 or 15 pip move is really now a 100 pip or 200 pip move, which sometimes it can happen like that. It can, but most of the time it doesn't. So you have to learn a lot of different things, and most of it's about you and how you internalize things and or react to what you thought was going to happen and then what really is being delivered in the charts. So I throw all that in there because I'm answering questions. Maybe it doesn't make sense to some of you listening to that, but those individuals that have emailed me, they have my responses in accordance to their questions. All right, so let's move on into, just for clarity's sake, let me just go back out to a daily and zoom in. I like this level down here on the downside still, and below that is here. And again, that's assuming strong dollar and running up into its buy sell liquidity pool. For what it's worth, my personal belief is we're going to probably stay in a range defined by last Friday's high, and probably it could rebalance between now and the end of the year to here, and probably just bang around. If it goes below these lows, I don't think that's going to set up any major run higher. I think it'll just stay in the range. For the bulls, it would need to just come down here, rebalance, leave this open as a breakaway gap, and then start to run that way. And then I would support the idea of a reclaimed bearish order block on the dollar index. All right, so let's go over to GBP. All right, so here's the British pound daily chart, and we have the old highs here, our relative equal highs we were looking for by Christmas. Well, we got that very handsomely. If we zoom in here a little bit, I'm drawing your attention to the fair value gap in here on this candle here. So we have a existing BISI still open with the low coming in on this candle at 130.51, and the high on this candle rebalances complete to 130.11 and 4 pipettes. So we have a little bit of imbalance here that could still drop cable lower, and that supports a little bit more continuation on the upside on the dollar index. But we could rebalance here. And how we react here at this candle, that's what I'm waiting for this particular week. I want to see what we do once we hit this candle's high, if we hit it at all, or consequent encroachment, which is the midpoint between this low and this candle's high. So we'll see what we get from that. It could obviously just touch this low, maybe go 1 pip below it, and then want to rebalance up to the bearish order block that would reside here, especially if this candle closes as it is with this high sitting at 131.29 and 2 pipettes. If this closes like this, that gives us a fair value gap with a bearish order block. We could see it trade down here, run back up in here, and then make a more meaningful drop lower for the sell side liquidity resting below here, and then attack maybe the fair value gap here, and then in here back to the bullish order block. Then we have relative equal lows with the sell side liquidity pool resting below that. That obviously would take us into January. I don't see all that happening in the remainder of this month, but that's what I'm kind of like looking at if I get a contrarian idea. All right, so here's the 1 hour chart on the British pound. We have consolidation, run down, expands up into the 135 big figure, price breaks down, comes back to an area of rebalance, sells off, rebalances again, sells off, institutional order flow entry drill, sells off there as well, completely rebalances all of this down to here, and then it starts getting sloppy because we're in a high resistance liquidity environment. Look at how much time we spent in here, and we had a run lower already. So there was a stop run with these equal lows right here. That's why price is meandering and drifting and grinding lower slowly but surely, just getting in there. Whereas these punches are quick, short little retraces, very aggressive punches real quick, eating up into all of this range in here. So all of this range, it keeps getting knocked away, knocked away, knocked away. And then finally we're back inside the range between this high and this low. With this low being a run on liquidity already, this form of manipulation, if this was not there, and we had this low, maybe the higher low it would form in here, not this lower low that's here, that creates high resistance liquidity runs. So this is the reason why we've moved into from a rather aggressive drop down, retrace, and then every drop lower was a very powerful, more meaningful, and the ranges on the downside are larger on this 1 hour candlestick chart, and the up close candles are rather small in comparison to the down close candles, which is another signature of institutional order flow, that it's bearish. But that changes, okay? That perspective and studying how the candles are forming, rather large candles when you're bearish and small candles when you're bearish, but they're up close candles. In other words, down movement with bearish institutional order flow is going to see large down close candles and small up close candles while it's retracing. It's in those small retracement up that new positions are taken before the large ranges are delivered on the downside. But when we rebalance and we enter areas that have shown a run on liquidity already, we've already done something down here in the form of manipulation. So we don't expect it to be a real quick solid shoot right down and it's taking the liquidity out. It's going to be a high resistance liquidity run where it requires a lot of that give and take in time and then it finally disrupts and goes lower. That imbalance on the daily chart here would again rebalance at that 130.11 and 4 pipettes here. So it's not like I'm expecting a whole lot. It's just I want you to study how we trade in here. I sent a tweet out today saying, or asking rather, to consider where the largest pool of liquidity is on GBP right now, and that is below this low. But even that still is encountering the signatures and characteristics of a high resistance liquidity run. And again, what makes this particular point between here and below this low, what makes all this a high resistance liquidity run environment is because we already had equal lows over here that were ran out and then this move materialized. Okay, it's really important you understand that, because when we don't have these runs on liquidity and in these big displacements, then this would be simply a low resistance liquidity run and just easy trading for a run below here. But because we've seen this point of manipulation here and sell side liquidity pool taken with this here, and then the move occurs, this range from low to high becomes a high resistance liquidity run environment because we've already had a point of running stops. Okay, so it's a real big takeaway in terms of your understanding for this midweek review. Moving into a 15-minute time frame, again, you can see it's really not a whole lot going on. Rather lethargic, meandering sideways. And I want to talk a little bit about the move that I put on Twitter. I wasn't able to record the whole thing because we're close to the holidays. My wife has me out just about every day shopping, so I'm not complaining. It's very fun, but I don't get enough time in front of the charts around this time of year, which is another reason why I like to be away from it. Which is, again, a reminder, next week we won't be doing anything. I'll just post a chart or two on Wednesday and Friday with no reviews. Okay, there won't be any market reviews, no market commentaries next Wednesday or next weekend. Okay, so just reminding y'all, don't freak out, because I like to enjoy the holidays too. All right, so we have sell side liquidity pool here, relative equal lows in here, and we have a fair value gap right there. Okay, we have down close candle, a big down close candle, and then another down close candle leaving the fair value gap. When price punched up into it here, I felt that these lows here and these lows here, that would be the next draw on liquidity. So I want short selling it right in here. And I'll show you the details in a moment off the paper trading thing, because that's the final discussion before I close this video for their midweek review. This rally up into that fair value gap, that was where I entered. And I'm going to drop down to a 5-minute chart so you can get a better appreciation for that. And when we do this, we find a swing high prior to that. That's here. So your stop loss has to be above that. Okay. And even though I retraced and had a little bit of heat on that move with this rally in here, the premise, as I teach it, it's still fine. It didn't get stopped out. I wasn't in any kind of jeopardy. And while it was modest drawdown, the high on this candle, which was not my entry, 133.42 and 6 pipettes, so 42 and 6, and the high was 54 and 1, so it didn't even go 10 pips against me, so it was about 8 pips or so. So 8 pips drawdown on a very volatile pair right now for GBP, and then you watch me adjust my target to take a run down into the mid-figure, 132.50. And it spiked down there really aggressively, and then we came back up. Consequent encroachment didn't get filled into here, but we had a institutional order flow entry drill. That was beautiful for that move there. Rallied lower and moved even lower as a result. But I just want to provide it was a 100 pip move. Just providing an opportunity to see what a 1 cent move, because I ain't been doing a whole lot of that recently, but I was inspired because some guy on the internet felt that he was bullish on GBP, so I looked at that as that was another contributing factor here. I saw a lot of willingness to post trades being bullish on GBP and their respective pairs and crosses. It was just very easy for me to go in there and do that. So I'm going to drop in here into a 5-minute chart. You can get a better view of what that looked like. And let me make this chart look like that. And we'll scrunch this up and take us back to the point of entry. Okay, so it was this candle here. And if you're new to TradingView, and I am too, below the chart you'll see a little tab that says paper trading. And I'm going to have to pull this up so you can see it because the cropping on my video. This is the tab you click on here. When you click on that, it'll open up. And that's what you get in here. Okay. And you can see the history. Here's the history. And account summary. See? The trade journal shows everything in here and where it went to. And account history here, you can see close, short position for symbol. Forex.com, GBP USD at price 3239.2, and it was 500,000 leverage, which is $50 per pip, and that's the business there. And it was a $5,015 paper trade as a result. When you're doing this and you want to practice using this, you're going to go down in here. This is what I've done. And again, I'm not claiming I know this. I'm just giving you something to work with because some of you are all very new. And one of the members from my first group actually tried to send me a video with some tips on this. And while I appreciated it and I was excited to see it, for whatever reason, the video wouldn't open up for me. So I don't know if I've done something wrong or if it needs to be resent to me. But anyway, I appreciate it. I do a right click down here and click on create new order. And up in here, based on the chart, I guess it's what it's working off of. So whatever you pull the chart up on, it'll, I guess, maybe default to that. Like if you're using your broker, if you're using Oanda's data feed or whatever. You can do the limit. You can do market. You can do your stop orders. You can buy in long on strength, or you can buy on weakness using a limit order. Your trade size, leverage is here, and you can do toggling here gives you a default of 75 pips, which you can obviously change, and toggling here gives you a default of 25 pips, which we don't do that. We use obviously the information based on what we've learned in core content and commentaries to dictate whether it's going to be a 25 pip stop loss or what it's really going to be. And then you just do your buy or sell respectively. There'll be more of this, and I'll try to do some live trading with you all. And I'm trying to get the YouTube live stream thing going again, and I'm using OBS, and for whatever reason it won't identify the Google tab like I have. This is TradingView, and I'm viewing it through through the Google Chrome browser. That's the browser I use, and it will only allow me to see it with Firefox. So I'm not sure what that's all about, because YouTube should be really having no difficulty using Chrome, because I think they're the same company if I'm not mistaken. But anyway, I want to give you a little detail about this, and then we'll close the video. What did I like about this trade, and what did I feel comfortable about doing it, and then being able to share it with y'all? Obviously, I outlined we had sell-side liquidity in here. Okay, and what I mentioned on the daily chart, how it was moving lower each day, reaching into its BISI, rebalancing all that. For this particular day, as it was trading sideways, I felt that we would make a run below here, and I wanted to see it retrace. I wanted to be selling as it rallied up. I knew that these equal lows in here, and then over here, retail traders would see that as a triple bottom, and they sent it up with a little bit of energy. I like to see that, and I'm going to sell into that. So when prices rallying up like that, I sell short, and then we had a little bit of immediate payment, and then it created all this in here, and then it started to rally up. Stop loss is above here. I don't care about any of this. The stop's going to do its job. If you don't feel that indifference when you put your trades on, whether it be practice or live, you're going to be affected adversely with fear and greed. The pattern is you trade the fair value gap, your stop goes above the previous swing high, and you let it go. Let it have its stop. If it's going to take the stop, then let it. Because that premium that you've paid by getting stopped out, you're paying for more insight. Because what you're going to do is you're going to see if you are stopped out, okay? And don't always assume that you are going to be stopped out. But if you do, let it happen. Because when you get stopped out, you now have a different perspective because you've put money in, it took something from you, and then now you're going to see what it does after it has hit your stop. Because if it hits your stop and then breaks down aggressively, normally you'd be too afraid to go back in. You would be too afraid to consider it. You wouldn't consider it at all. But because I've taught you other concepts and techniques, you can use breakers to get into it again, or you can use a run back into a fair value or an immediate rebalance. Okay, so if it starts to break down again, we won't be looking at that, or I wouldn't be looking at that and saying, oh, I got stopped out, I'm scared to trade now. I'm just going to go in there and look for speed to run away from my stop loss being hit, and it starts to break down. Then I'm just going to look inside that initial run to give me a trade to get back in. And I'm just going to have to forfeit the higher entry because I got stopped out, and it's the cost of doing business. But I want you to look at it from the point that we've had a consolidation in here, and we're entering the latter stages of the day. So this is kind of like a late expansion New York trade. Consider this kind of like the Asian range would be, where we have a consolidation, and then this is the Judas swing going short, and then this is all London and in New York. So it's power 3 being applied just with an intraday template where we have initial consolidation and then the expansion late in the day, because we didn't get any kind of run heavily on any of the sell side liquidity here or here until we had a deeper retracement. Keeping the pattern intact, which is run back into the fair value gap, stop would be above here. This was an area of protected liquidity. Why? Why was I not fearful of getting stopped out? Because I could very easily had anxiety. I could have been worried about it. I could have had an opportunity to take some of the risk off, split the position in half. I didn't do any of that. Why? Think about what I just told you in response to how the cable market is trading into a high resistance liquidity run to get that sell side liquidity pool on its daily and hourly chart. Same thing happened here. We have a swing high, fair value gap, price comes back up, fair value gap, and buy side liquidity is taken. So there's a form of stop rating and manipulation here. So for it to come back up above it again, that's not a stop run. That's going to be a more meaningful indication that it's probably very bullish, because we've had a stop run here, and then it creates an intermediate term high, and it rolls lower. Then we have a short-term high, which a short-term high can get violated, and the market structure still remains intact, which is bearish, because we have a high, a lower high, a lower high, but this high between this high and this high makes this an intermediate term high. And it's further evidenced because we have a high with a lower high and a lower high, and it's lower than this high and it's lower than this high, making this high. Again, if you don't understand what I just said, I basically outlined market structure, and I've done teachings on that, and it's all in my free content too. So it's not necessarily something you got to find in mentorship, but we talk about it here too. But this high shouldn't be broken, even if this high is broken on the upside. And you can see that this retracement back here doesn't violate that. So even though all of this looks scary if you were in it going short, it's just them coming back to take out this pool of liquidity and leaving this one intact, because this one had already done its job by taking the buy stops out here and rebalancing the fair value gap here. This high can be allowed. And again, this is the reason why we do not take our stop and move it down if we're short, or move it up when we're buying and going long, until it takes a point of first scaling. In other words, if we go to a level where we can take out a first profit, that's the only time we start to consider moving the stop loss. Because otherwise, you invite the opportunity of getting stopped out, which if I would have brought the stop below this high, as we were starting to drop down in here, from here to here, if I would have lowered my stop, I can't take partial profits yet because we haven't gone below these equal lows. And as the market started to retrace, I'm following the rules. I'm not going on Twitter. I'm not going on social media. I'm not emailing other people, say, hey, what do you think is going to happen with GBP? I'm trusting the concept. The setup is enter, stop here, wait for a breakdown. Allow the stop to happen. It's not going to be the end of your career. It's not going to be the end of my career. It doesn't create the opportunity for failure to continuously happen afterwards because you had a losing trade. I had sentiment on my side. I had a retail guy barking, saying that he's bullish, 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 bullish. Well, that's all I needed. I had everything else technically here to align up with that, and then we have power 3 creating a low, and I got out on that candle as it went into that 132.50, and it went a little bit lower than 30 seconds it was. Yeah, 32.36 and a half. So I didn't get the actual lowest low, but again, these are all something that I planned on showing on Twitter, so I can't really bring up too much. I could have went in here and did some more adding, but I didn't want to do that because, again, I just wanted to show what 5 handles versus something that can be shown to show 100 handles with our concepts. It pales in comparison. So anyway, that was the outline and why I did what I did with British pound here for a 100 pip move and one shot, one kill. Beautiful, beautiful, beautiful setup. And we'll see if we get any kind of continuation in the volatility as we go in the latter portions of this week. And I just want to take one quick look where we're at right now, and it's still sideways. And that's what we got right now. All right, so I'm looking for, again, a deeper run on British pound that would take us below this low here, and that would rebalance that hourly chart in here. So all I have to do is touch that. That's enough for the fair value gap. But then the next level will be consequent encouragement, and then the next level would be the low of the fair value gap, which is over here, and 130, 11, and 4. And that, my friends, is going to be it. I will catch up with you by way of Twitter if there's anything to be drawing your attention to. Again, we're going towards the end of the year. Shouldn't be a whole lot of excitement. I think this was pretty much the end of it for 2019, and now it's just the scalpers market going into the last day of December, going into the first day of January. And I will catch up with you by way of the weekend review. Until then, I wish you good luck and good trading.